Hi, everyone, and welcome to the first quarterly private capital markets webinar summary. My name is Sherwood Neese, and I'm joined by Jason Best.
Hey, everyone.
Today, we're going to give you a brief summary of what we covered a couple weeks ago in our full webinar. It was almost 90 slides long, and we sliced and diced all the data coming out of regulation crowdfunding. And we think it's pretty interesting. And no matter if you're an entrepreneur, an investor, a policymaker, a regulator, a portal, you will learn a lot from the initial data that is coming out of regulation crowdfunding. I'm the one on the left there. That's me, Sherwood Neese. Jason Best is on the right. And our third partner in the fight to legalize debt and equity crowdfunding, Zach Cassidy Dorian, is in the middle. Not going to really talk about the three of us, but really just jump into the fundamental shift that took place with the Jobs Act. And that shift really is taking all the data that happens in the private capital markets and really behind closed doors and bringing it online in a digital footprint so that we can look at it, we can analyze it, we can look for what leads to success. And that's what this webinar was all about. We're not going to have time to really go into the CCA crowdfonomics equation, but if you do watch the full webinar, I think you'll be fascinated to see how now that we have data points online and now that we have variables that we can look at, we can start to gauge what success looks like with crowdfunding campaigns. So with that, I'm going to first turn it over to Jason to give you some narrative for this entire summary, and then I'm going to swing back in later on and dig into some of the interesting data points that we've uncovered.
Thanks, Woody. Well, since the passage of the Jobs Act, Crowdfund Capital Advisors has now worked in 40 countries around the world to help bring this opportunity of online finance to both developed and developing economies. And the biggest difference between those two markets is really the existence of functional financial markets. And that really defines the different sort of adoption curves and pathways online finance. Now, if we drill down into specifically the US market and look at the next slide, how the public markets moved online in the US starting in about 1996, you had new technology, which was the web at that time, but you had existing investors who were investing into existing asset classes, and existing issuers or companies that were raising capital. So there was only one type of new thing in this market movement. In the movement for the private capital markets, as they move online, beginning in 2014 and for the next few years, you have new investors, a new asset class, new issuers, and to some extent, new technologies as well. And so this will, create the on-ramp kind of profile that we're seeing play out in the US and have seen play out in the UK as well, because the United Kingdom is actually pretty far ahead of the US in its utilization of crowdfunding. So we're really looking at this market adoption dynamics over the next 24 to 36 months. Now, in the next slide, we really dig into the narrative. And as Woody was saying, we've really built out this analytical platform, and that this will be the first of a series of webinars and analysis periods that enable us to, for the first time, have really deep insight raising money through the private capital markets. And not just for the slice of companies that are raising money through private equity and VC, but actually all types of companies, which that kind of visibility has never been available before. Now, the things that we've identified that are going to be important in accelerating the growth of this market are not really surprising. First is execution. The fact that crowdfunding platforms and related fintech companies need to focus on executing every day their tactics and strategies for success. Now, the thing that will help them in that regard over the longer term is really creating and leveraging standards and tools to facilitate a liquid, efficient, and transparent market. Some examples of these types of tools are: how can we create documentation standardization services? How do we have more robust investor relations types of tools? How do we lower the cost of due diligence generally? And then also digging into how do we create and then leverage data standardization services and valuation services and compliance tools that will help this market grow so that people can really compare apples to apples in an efficient and effective way. Now, as we look at the initial 5 months of data we have so far, we can say that there's no sign of an irrational market or irrational exuberance or Dutch tulip bulb kind of a market. That this is a market that's growing in a rational and reasonable pace, and we think that's a good thing. Over the first 5 months, we've seen about 14,000 investors come to this marketplace and have funded 48 deals. So these essentially are micro angel investors, people who instead of writing $25,000 checks for a typical angel investment are writing much smaller checks. And this represents month-over-month growth now at about 20% month-on-month, which is great. California, from an issuer perspective, the state of California is leading the way with the volume. And while it's too early to discern any seasonality in the data, we are seeing some interesting information about which days of the week are most efficient in raising capital, which will help target marketing efforts over time. When we dig into portal performance, not all portals are created equal. What we've seen is the fact that the early portals, those portals that were first to market so far, have an edge. We will see over the coming months and years if that maintains itself. One of the things we're concerned about is fees are varying widely, which is to be expected, but a race towards free as a way to do market adoption is really not the way to go, because that is not going to create a sustainable long-term service and a long-term industry. What will do that really is the ability to compete on features. Investors acquisition and growth in this market is growing at about 100% month-on-month. And when we look at on the issuer side of things, what we're seeing is that from an issuer perspective, preparation is everything. The most important phase of your campaign in raising money online is before you launch the campaign on the portal. It's the preparation, it's building your crowd, building your social media, building your marketing strategy, building your communication strategy, so you really are able to execute efficiently. Now, for companies who are able to reach their goal, they're doing it in 38 days, which we think is pretty interesting and significant, because you compare that with the amount of time it takes to raise money in the traditional way, which could be 6 months to 18 months. And so if you can actually shrink that process down to a much shorter period of time, that's an incredibly powerful opportunity for an early or mid-stage company. How old are these companies? Are they all startups? Well, actually, no. About half of them are startups. About a quarter are 2 to 3 years old, and about another quarter are over 3 years old. So an interesting distribution there. We've also determined that we can see at what size your social media network is, how much money you can raise on average. This is really important, again, during the planning phase when you're trying to determine how big of a social network you need to get to before you're able to raise the type of money you want to be able to raise. Video quality matters. We've got data that demonstrates exactly what that means. And so that can be very, very important in understanding how to make that investment in video and what kind of return on investment you can expect. On average, we're seeing investors invest $863 in an issuer's campaign, which is an interesting place to start. When we look at the UK, the United Kingdom has had crowdfunding now for 4 years, and their average investment size is $2,000. We believe that's for 2 reasons. One, a 4-year track record of experience, so the more experienced market. And 2, the UK government has put in place some very interesting and progressive tax benefits to making investments in small and medium-sized businesses, and we certainly hope the US government will look at that as well. Now, finally, one of the really important aspects from an issuer perspective is the different types of tools that are available. And one of the tools that really very few people are talking about so far is revenue-based financing. If you're not going to have an IPO, if you're not going to have a sale to Amazon or Google, the ability for you to give a return back to your investors on a monthly basis based on a percentage of your top line revenue is really a powerful motivator for investors and an efficient way for you to raise capital. We've seen some very well executed campaigns in this revenue-based financing model, and we think it's a great fit for Main Street businesses to consider, and also for other more traditional businesses to consider as they're trying to decide their funding strategies. As no surprise, technology businesses have led the way. However, food and beverage is following, and we're also seeing some other types of industries that you wouldn't think of for crowdfunding. They're beginning to experiment with these tools. Now, as we move on to the kind of like summing up, we want to be able to compare this regulation crowdfunding to the other types of crowdfunding that were permitted in the Jobs Act. which is Title II, which is the ability for companies to raise capital online from accredited investors only. And also Title IV of the Jobs Act, which is also called Regulation A+, which is the ability for companies to raise up to $50 million from both accredited investors and retail investors. So at the outset, we should say that we're challenged in our analysis because we don't have apples to apples comparison data across all three types. And so we certainly hope that over time, the SEC will start to get access to the same level of data in Title II and Title IV that it enjoys in the Title III space today. In the first 6 months of Title II, there were over 1,100 issuers that raised money. So a very robust market over the first 6 months. Again, this is because you have a market of investors who understand the space, and all you're adding is new technology. In the regulation crowdfunding, or the newest part of crowdfunding, we've seen 142 issuers come to market. And then in Title IV, which is a more complicated offering type because you're raising from both accredited and retail investors, and you're raising up to $50 million, we've seen 8 of the 24 submissions to the SEC be approved and go out to raise money. Now, one of the really important things that governments pay attention to is job creation. And certainly it's a well-believed statistic that small and medium-sized businesses create most of the jobs in an economy. And we've been interested to see that so far in the different types of crowdfunding, over 7,000 jobs have been created, which is a great number. And we look forward to that number continuing to grow and continuing to demonstrate that this adds jobs. In fact, in the UK, it demonstrated that they're adding on average 2 jobs when a company raises money through crowdfunding, which is pretty significant. Real estate crowdfunding as a sector is an incredibly fast-growing and high-interest model. And so we think that that is a space to watch, and one that can primarily will be utilized by Title II and Title IV of the Jobs Act. Again, based on the UK market traction and adoption, we think this is a 24 to 36 month phenomenon of a steady, measured growth in this market. Once we're able to demonstrate exits, demonstrate success, then we think we'll see a much more rapid adoption cycle. The other point, and the last point in this section, is really about the macro effects. And I think this is what also will drive market adoption. When we have the next economic downturn, we will see capital markets dry up again, especially for those most in need in the small and medium-sized and startup business sectors. And at that point, we will see a more rapid adoption of these tools because they will be the option that is available to those companies. And so we think that right now we're off to a great start, and I'll hand it back to Woody for some more detailed analysis.
Thanks, Jason. For those of you that are listening, if you've ever raised money online, you probably did it in a meeting in a boardroom behind closed doors. You shared documents with investors, and that information was kept really secret between you and those investors, and it wasn't shared publicly. Investors, same way. They had information, they had meetings, and they looked at information, and they made decisions based on that meeting, on that information that they had. The fundamental difference, and I made reference to this early on, is that all this information that is being shared now is being shared online, and the data rooms that have it all are public access, such that we can collect all the information about companies that are seeking capital online, and we can analyze it. Now, what's important about that is you start to look at typical information that companies disclose, which are earnings, revenues, customers, jobs, their accounts receivable, payable, all of the traditional stuff that's stored online. But now we can look at other things like their social network, we can look at the video quality, and we can start to learn how big their social network is and what kind of impact the video or the social network might have on the outcome of a campaign. Now, the critical thing in all this is we're storing facts and figures about valuations now for the first time. So when a company is out there raising money, we capture the valuation at which they want to close the offering. If they're successful at raising money at that valuation, well, that means that that valuation is set in stone, and that's the valuation at which the company was successful. Of course, if they didn't hit their valuation, according to the law and regulation crowdfunding, the money's returned to investors. So when we're looking at this data, and we did build the database, we started this back in, when the industry got started, we sat down with our team and we said, what are the data fields we need to capture? And we have about 408 columns wide of data that we capture. Our data points is about 182,000 at this moment. So you can see there's a significant number of data points to look at, analyze, and compare. And so what we want to do in all of this is we want to look at all the companies that are raising money, all the variables around that, and we want to compare that to the companies that were successful with crowdfunding and look and learn what the difference is between the companies that were successful and the ones that were not successful. And so that's what we're going to start to do. I'm going to share with you 3 slides right now that really dig into some of the data and some of the early signals that are coming out of regulation crowdfunding. Now, the first one is probably the holy grail. Everybody wants to know, what are valuations in crowdfunding? What does it look like? What are these companies that are going out and seeking capital that are successful? Where are they heading, or where are they hitting in terms of their valuation? And we look at it from 2 points of view. We look at it from the median and the average. So the median sort of takes everything and goes right in the middle and says, what's the valuation that's smack dab in the middle of all the companies that are raising capital? If we look at all the offerings, and that's what that chart sort of shows you, the median valuation of all companies selling equity using regulation crowdfunding is about 5 million. Now, if we just take out only those companies that were successful and say, well, what about the companies that were just successful with crowdfunding? What's the median valuation of those companies? It's a little higher. It's $6 million. So that means the companies that were successful have a higher valuation from a median perspective. The same holds true when we look at the average. The average really just takes the sum of all the valuations for all the offerings and divides it by the total number of offerings that are out there. The average valuation for everyone that's selling equity using regulation crowdfunding is about $6.4 million. Now, again, if we filter it out only for those companies that were successful with crowdfunding, it actually jumps up to 9.3. That's a pretty significant jump from our perspective. And so when we started to drill down in the data, and of course, now that we have access to all the data, we can see what's going on. We found that there were 2 outliers that really were skewing the results here. One was GreenSense Farm, and they had a valuation of 56.3 million. And the other one was Saunders Electric Car, and they had a valuation of 32.4 million. Because they were both successfully funded, those valuations were included in the averages. If we take them out of the average valuations and the average pool, the total pool of successfully funded companies, it really comes back down, and the average valuation drops to around $5 million, but it's a little less than 5 million. Now, what is significant about this is when you compare that valuation to the type of valuations that angels and VCs are paying for early stage companies, it's actually not that different from what they're paying. So the crowd is not being taken advantage of by the issuers. The crowd is not being taken advantage of by this mechanism called regulation crowdfunding that's out there. That's a positive sign for what Jason was talking about in terms of the logic that is coming to the marketplace from both issuers and investors that are entering it. And we think that's a very positive thing. What's great about seeing valuations like this is it will help shape other issuers, entrepreneurs that are coming into the marketplace, helping them try to decide what is the right valuation for their company. If you were to go into the full webinar, you would see that we look at valuations based on region, based on state, based on industry, based on sector. We drill down into every way that you can look at a valuation, even looking at it from the corporate structure and the type of security that's offered. It's amazing the type of detail and analysis you can get when you have all the information at your fingertips. This next slide really digs into and answers the question, how many investors do I need to have in my campaign if I want to be successful? And what's the average amount of money that they need to put in for me to hit my minimum funding target? And so when we looked at this, and we looked at all campaigns across the board, we found that the average number of backers per campaign was 167. Now, if we filter it out again for only those campaigns that were successful, it jumps up to 279. So the campaigns that were successful had a lot more people that are backing them. And, if you think about it, that does make sense. One of the reasons why campaigns probably don't hit their funding target or miss their ultimate goal is because they're lacking the investors that will back it. So there's a little logic in that. Now, what was interesting is the next number, 840 versus 863. So if we look at all regulation crowdfunding offerings, the average commitment by investor was $840. So that's what we're doing here is we're summing up all the commitments that were made by all the investors and dividing it by all the investor commitments. That average was $840. Now, again, we can filter it out for only those campaigns that were successful. And in doing so, we only look at those companies that hit their funding target and closed on their offerings. In that scenario, the average amount that is invested goes to $863. It doesn't really jump like the average number of backers, but it goes up a little. So we thought that was interesting in the sense that the average investment right now is floating around $863. Another interesting point about this, it has gone up over time. And in our full webinar, you would see that it starts at a much lower point and it is scaling up over time. So issuers can learn from this. They can learn how many average investors they're going to need to be and go to their social network and see, do I have that right number of people in my pool of potential investors? And then they can figure out, if I do, are they going to have that average amount that is needed? And what will that look like in terms of what I'm going to be able to successfully raise for my business? Now, finally, might be the other big question we get. How many people do I need to know in order to raise money? So because we collect all the information about issuer and entrepreneur's social network, and that social network means their Facebook, their Twitter, their LinkedIn friends and family, we can start to analyze the type of impact that the social network has on funding success. And if you look at the chart right there, you'll see that companies that were raising $50,000, the average size of their social network, when we sort of reverse engineered it to look at the successful campaigns that closed around there, had about 1,500 people in their social network. So what does this tell you? It tells you that if you don't have 1,500 people in your social network, you're probably not going to be able to raise $50,000. So you need to build your crowd before you go out to raise money from them. Now let's talk about a couple other things that's interesting about this chart. If you look at if you want to raise 100,000, it jumps up to about 2,500 people that you would need in your social network. So you can see more people, more money you can possibly raise. Now, the fascinating part about this is what happens between 200,000 and 1 million. Well, the average size of the social network for those people that were successful at hitting their funding target jumps up to 9,600 at $200,000 and all the way up to 12,000 at 1 million. But what we thought was interesting about this is the difference between 9,600 and 12,000 is not that great, but the amount of capital that you can raise is very great. So what does this mean? It means that the people at the $1 million level are leveraging their social network better than the people at the $200,000 level. It doesn't mean that the social network needs to be bigger. It just means that they're able to get more money out of them. So we thought this was a very interesting point for people that are looking at regulation crowdfunding and raising money for their enterprises to help them figure out how many people they need in their social network and how much capital they most likely could get out of them. If you have over 10,000, you very likely can raise over $250,000. You're just going to have that right marketing message to be able to get a large amount of capital out of them. So that's about it. I mean, like we said, there's 87 full slides in the complete webinar. The data is truly interesting. Our database is growing on a daily basis as we get more information. We would like you to pay attention and come to our quarterly private capital markets webinar. If you have any questions, please reach out to us. And thank you very much for spending this short time with us today.
Thanks, everybody.